Hi, my name is Owen Magabinawo, and welcome to Hire Your Virtual Assistant, also known as Hiva. Well, it gets to a certain point as an entrepreneur where basically you're going to have to figure out how do you get people to come in and invest in your business. How do you go out there and raise funds? Well, I have someone today on the show. I'm very excited because this person, Steven Silver from Maven Funding Advisors, has actually been able to go out there and successfully raise venture capital funds for his own business, as well as go out there and raise funds for other small businesses. And I felt, let me get him on the show so he can share his insight and experience on what you need to know about raising venture capital funds so that you can go out there and raise money for your business. And hopefully, based on your success, you can come back on the show and share that with us. So I look forward to talking to you at the end of the interview. Hi everyone. Today I have Steven Silver from Maven Funding, and he is an expert when it comes to raising capital for small business owners. And I thought that the best thing to do is have him on the show to share with you guys his insights. So go ahead, introduce yourself to the audience.
Thank you, Owen. My name is Steven Silver. I'm with a company called Maven Funding. We work with early stage companies to help raise capital and get companies through the process of the venture capital space. Basically, I've worked with, in the last few years, a couple dozen companies. In 2009, we raised about, I'd say, a little bit over 13 million for about 12 different startups, and that's pretty much it.
Okay. Yeah, your history it's very interesting in the sense that I want you to go to give them some information of your background as how you even got started before you even started working for Maven.
Absolutely. So I actually went to school in Boston studying entrepreneurship at one of the only schools that focused strictly on entrepreneurship over the past decade. And Babson College is right outside of Boston, about 30 minutes outside the city. #1 school in the nation for entrepreneurship. And during that time, really focused on every single aspect of building a company, from finance to accounting to marketing to sales, you name it, we had to cover it. Started my first startup in college, had a nice little sale my senior year, and basically went from there. Met an angel investment group, a nationwide one called Keiretsu Forum. Met them in Boston, started working for them as an intern during college, and was lucky enough to get a position there screening entrepreneurs and being basically the entrepreneur director. So I was at Keiretsu for about 3 years, managed, I'd say, about 250 local Southern California investors.
Okay.
Although Keiretsu has chapters all over the nation, all over the world.
Yeah, just for the audience that probably might not know what angels and angel investing is, just give them a brief intro on that.
Absolutely. So an angel investor is basically anybody. It could be friends and family. It could be a wealthy individual. Somebody that's an accredited investor that's willing to invest in your company, whether it's a startup, an idea, all the way up through venture capital, which is much more upstream, much larger rounds. Our angels at Keiretsu typically would invest anywhere between $50,000 up to maybe a couple $100,000, maybe $500,000 at most. Mm-hmm. And the idea is that entrepreneurs would come and pitch to these investors monthly, about new entrepreneurs. And if the opportunity was good enough, the investors would run their due diligence and decide whether or not they wanted to invest.
Great. And so I brought you on the show because I want you to share with people what they need to do in today's economy. The market is tough, but you still need to be out there trying to raise funds. And you have your own presentation you want to share with the audience. So go ahead.
Absolutely. I'll basically start with the fact that, yes, the venture capital market has shifted dramatically in the last decade.
Yeah.
Last 5 years of me being in the industry after graduating college in, 2007, basically, it's a whole other ballgame. Investors are looking for those 1 in 1,000 deals, and unless you have very wealthy friends and family who are able to front some money for you to start your project, it's a really difficult path to raise capital. And I presented this presentation, which I'll get into in a second, with a number of investor groups, a number of funding sources, fundingpost.com, for example. I do a lot of work with them. And for example, I'm just going to pull up this presentation. Let me try to get this. All right. So this presentation was created for entrepreneurs to basically sum up the early stage venture capital space, as well as talk about a lot of the key common denominators among what investors are looking for when it comes to a great opportunity, a great investment. So I'll start with this slide. The venture capital space over the last 5 years has, like I said, changed dramatically. Basically, the large VCs, the earlier stage VCs, anybody investing anywhere between $1 million all the way up through, let's say, $20 million, they really tightened their belts and wanted to move downstream and start investing in smarter, less risky, less high reward even investments. And they're really trying to balance their portfolios.
Is there a reason why they're doing that, moving from the big ones to the smaller ones?
Well, it's really just mitigating risk. Investors are realizing instead of investing $100 million into this one company, I'd be better off investing $1 million into 100 companies and having one of those succeed and end up paying off all of the rest.
Okay.
So what we're finding is that the investment dollars put in by institutional investors, which are defined by VCs, early stage VCs, and angel investors, has really cut off dramatically. In Southern California, I could speak for Southern California alone, to give you an idea, in 2005, there's probably about 40 deals done, whereas here we are in 2010, 5 years later, and there's only been 2 deals done in pretty much all of Orange County at least.
Okay.
But the one thing that we do notice is that friends and family investors are putting money in because there's less money out there. People are having better ideas, and families, friends, anybody related to the CEO or the founder of a company is willing to get that going.
Okay.
So how does this affect the entrepreneurs? Well, you have a trickle-down effect. What it's causing is entrepreneurs to use less money, meaning they need to raise less capital, and they're keeping their burn rates low. They're doing that because they're bootstrapping. They're finding out less expensive ways to get their companies going, and they're getting in revenue a lot quicker.
Okay.
So leading into that, what are common denominators among companies that I've seen funded over the years? I worked with 12 startups that were successfully funded last year in 2009, and here's some of the things that I saw. Basically, every one of those companies was either making money or very close to revenue, meaning they've proven their concept. They have proof of concept. That's the real key here. Secondly, their teams were phenomenal. Any companies that received any sort of institutional funding had experienced management teams, ones that typically have done it before and are ready to do it again. These entrepreneurs thought like investors. That's really a really important fine comb type topic that nobody really covers. If you are asking somebody for money, you need to really put yourself in their shoes and think, what would I want to see?
Okay.
So moving into it, internal documents, I think, are something that many entrepreneurs misunderstand. They confuse it with an investor package. Investors, and this might sound surprising, investors don't read business plans. Back at Keiretsu and pretty much every VC I've ever talked to and worked with, if you put a business plan on their table, a 30-page, 50-page, 100-page business plan, they're going to toss it in the can. It's not so.
Why is that? Because a lot of people have that understanding that you have to have the business plan or all the paperwork in front of these people, and you're saying that's not the case.
Well, put yourself in their shoes. Once again, if I'm an investor and I have even one deal a day, which is not regular, I usually have 5 or 10 deals a day coming in, do you have time to sift through a 100-page business plan for 30 to 300 deals a month? It's just not realistic. So these investors really, really appreciate having a clear, concise, really well thought out, well designed investor package made just for them.
Okay.
It's it is crucial to have a business plan. I'm not trying to really downgrade the importance of a business plan. Business plans are great internal documents. They're made for you to guide your company, to keep everybody in your company on the same page, but investors don't read business plans. Investors want a 1 to 2 page executive summary, a nice PowerPoint presentation perhaps, and some basic financials.
Okay. When you say basic financials, can you elaborate a little bit on that?
Absolutely. We'll touch on it right here.
Okay, go ahead.
Investors are looking for a 3 to 5 year investment plan. They don't want to be stuck, at least in the venture capital side, in a deal for 10 years for it to make them $1 million. It's not realistic. Okay. They're looking for 5 to 10x returns, minimum, and ideally they'd like those 100x returns like the Googles. But basically, speaking to this slide, you have to base your financials off of those projections. If an investor is going to put in $1 million and they're going to get 50% of your company, let's just say, then they're going to want to see $10 million out of it within 3 to 5 years. How are they going to do that? Well, your company better be making about, what is that, $20 to $30 million by years 3 to 5 for them to sell out their 50% shares.
So does it mean that they have to see something maybe on a smaller scale that is kind of similar in the percentages so that they...
Exactly. They want to see some traction, and they want to see a reasonable doubt that you're going to be able to continue that traction and grow it into the type of projections that are going to get them a 3 to 5x return. So many times people come to me with a plan and they say, Stephen, your investors are going to love this, it's going to be great, and I ask for financials and they say, impossible. With startups, financials are meaningless. And once again, going to the investor's perspective, that's probably the worst thing you ever want to tell an investor. If you can't make some sort of assertion saying, my goal is to acquire 0.1% of this market size, which equates to $50 million in revenue, which means we need to sell this many widgets. If you can't make that sort of logical progression, you really need to sort that out before going to investors and asking for money.
So that's kind of like you need to have a logical assumption base that you can work off from, or maybe even have it already existing already. Is it two things, or they prefer to already have all those numbers existing, maybe on a smaller scale, or you need to have something that's logical, but you are assuming, making an assumption?
Absolutely. I mean, it's an educated guess, and that's the best it can be, but that's what you really do your market research for. And when you build your business plan, you can see here on this slide, a solid business plan is one of the biggest things you could do to become fundable. I'll touch on some of these other things really quickly, and then we'll get back here. But clean formation, I've seen acquisitions from Google actually go under just because the company messed up a little tick on the legal Zoom when they founded a company. You definitely don't want to risk any mistakes on your formation of your LLC or your corporation going in, because that can affect future rounds of funding or even acquisitions. It can be really devastating.
Can you give us some examples of mistakes you've seen?
Yeah, I mean, a lot of the mistakes sadly have been because people have incorporated or done their LLC on LegalZoom, and they simply just mismarked one of the boxes, and it's required an extra few months of going back and changing that paperwork with the federal government, and that extra month or two actually caused the deal to go under. So it's time. That's what it comes down to. If somebody wants to make a deal right away, you want to be 100% prepared without any hiccups.